Let's bring in New Edge Wealth's Cameron Dawson and CNBC contributor Capital Area Planning Group's Malcolm Ethridge. Trivariate's Adam Parker still with us at this hour. Cameron, let's start with you because we were just talking about whether the economy is slowing down. If it is doing so, is that consistent with where you see valuations in the equity markets right now?
Certainly not. We don't think that the equity market is signaling any concern about a more meaningful slowdown in growth because, as you said, equity valuations are at 22.3 times forward. You also have earnings estimates that continue to go up. You've added about $7 a share to 2026 earnings estimates. Now, for 2026, up to $302. It should be noted, though, that those earnings revisions higher are coming from just the Mag 7, a very small cohort of stocks. You actually are still cutting equal weight estimates. So to Adam's earlier point, the market is not the economy, but because earnings estimates continue to move higher, you're in an environment where stocks can continue to press higher.
And it may speak a little bit about what Adam said regarding productivity and kind of how that's working its way into corporate margins as well.
Yeah, I mean, to get look, it's innocent until proven guilty. All the original AI investment, we're told, back half of 26 into 27 is we're going to see the productivity from the company. So what are you going to learn in the next 3-4 months that's going to derail your dream that we're going to have productivity in 27? Not much.
Right.
So if you're anchoring to the median company can have margin expansion a year, 18 months from now, and you're anchoring to a more dovish skew to the Fed, that's the cocktail for bullishness. We got to watch out for froth, the crazy valuations, you know, all that kind of stuff. But I think the North Star is we're headed higher over any meaningful period.
Malcolm, in the short term, you think tomorrow will be a sell the news event. Do you think it will stay lower, that equity valuations will stabilize lower after tomorrow? Or do you think it will be a short-term phenomenon?
Yeah, I think it's more likely to be a short-term phenomenon. I don't think that investors are likely to suddenly find religion tomorrow and start focusing on valuations in comparison to the promise of AI, like Adam was just saying. I think more than likely it's going to be a short-term knee-jerk reaction is sell the news and then figure it all out from there. But I definitely think that the guidance or the lack thereof on what the next cut will look like will suddenly have traders trying to parse out where does the Fed go from here? How much impact does the White House have on the next round of cut or cuts? And will we actually be able to posit the fact that maybe this means something for the economy, maybe this means something politically? Those sorts of ideas are the ones that are really going to drive the conversation the last quarter of the year. But I think more than likely investors are going to focus on AI above all else, and the party will keep on going.
Yeah, and that lack of clarity speaks to what we were just discussing with Steve Leisman regarding, whether there will be an inclination to give forward guidance if there's not consensus within the Fed. Cameron, given the equity valuations and where they are, how fragile, how sensitive do you think the markets are to any kind of a negative shock at this point?
The biggest saving grace for markets right now is that institutional investors, based on the Deutsche Bank consolidated equity positioning as well as Goldman Sachs index, that these investors are still relatively neutral and even slightly underweight positioning. That still means that you have this potential for a positioning chase higher. But as we move through the fourth quarter, we think that the higher that this market moves, the more fragile it is to incoming data that potentially challenges this very optimistic view about growth. So when you are priced for perfection, you do need perfection. And if we were to say rally to 7,000 by the end of the year, which is some price targets that exist, that you would be trading at 23.5 times forward earnings. And that's an extraordinarily fulsome valuation. So it probably is more of a 2026 issue than it is necessarily something that investors will consider for 2025, simply because that positioning is still light to neutral.
I got asked twice today, hey, I've had a good year. Should I lock in my returns, just kind of go turn off the engines and just kind of lock it in? And, you go back and look, in most years where you've had kind of mid-teens returns, and we're up over 30% since April lows, the average, by the end of October, the average is still up a lot in November, December. So sometimes I think that second bullet under Cameron thing where you can have like a melt up, I think that's still where people's heads are. I think if we get a solid October earnings season, I think people were sort of shocked at the move in Oracle, and they're thinking maybe there's a couple more of these kind of juicy things happening in October, and they just can't. you can't be behind 400 or 500 basis points versus your index if you're long only. So I think there's still going to be a melt up. I kind of really like the bullets that Cameron laid out there, because I could see a scenario you get a sell-off, usually January strong. I could see this year being good. I could see people chasing it all the way through year end and then kind of say, all right, let me worry about rotation later, because right now the party's still kind of fun. And if I'm hungover later in the year, I'll hydrate then. So I think right now there's just too much dreaming. And if I've learned anything about equity investing, I buy my little dream today, I sell it to somebody with a bigger dream later, and I still think people are going to dream bigger later in a lot of parts of the market when they start seeing the productivity proof cases. A meeting earlier today, somebody said, I wish we had an agent in the room to sort of measure what we're doing. People are just starting to warm up to AI productivity, and they're not fully there yet.
Yeah.
I know Malcolm knows a lot about this stuff, but just saying, not everyone does. Yeah.
Well, Malcolm, one thing that I thought was interesting in the notes today was this idea that you think there's an opportunity from a rate cut in fintech. So maybe you could comment a little bit about what Adam said regarding just the melt up from AI productivity, as well as how that fits into your fintech thesis as well.
Yeah, so marrying the two themes, right? Adam started out talking about the big three and how they'll likely do well following a rate cut. But I think that it's also important to consider other parts of the finance ecosystem that are immediately impacted by the shorter end of the curve, right? The 2-year, for example. So if we're talking about a quarter-point cut or a half-point cut or whatever by the end of the year, that immediately is impactful to companies like a Lending Club, an Ally, or a SoFi, which I own personally, because they actually earn the bulk of their revenue from transaction volume and not necessarily on that net interest margin like a traditional bank, the GSIBs. And so I think that's a great place for investors to place themselves if they're looking for a trade that's bound to do well, regardless of how large the cut happens to be.
Yeah, and it's no coincidence that we've seen a slew of these fintech names do IPOs this year as well, hoping to kind of feed onto that trend. Adam, Cameron, Malcolm, thank you so much for joining us today.
Good to see everyone. See you guys.